This year has been a very interesting year because the key macroeconomic variables have all been muted. Consumption is still very low. Investment is equally very low. Government spending is coming up, but not at the level that will really accelerate a lot more growth and multiply effects in the economy. And what we've decided to do, given the period, is to keep the priorities of preserving value in terms of asset quality, and also driving efficiency across every aspect of our operations, as well as also accelerating the pace at which we are getting into the retail segment. And in terms of efficiency, you see that play out because if you look at our cost of risk, where there's a remarkable improvement from about 1.something% down to 0.9%. We've also seen a cost-to-income ratio quarter-on-quarter improvement from 52.7% to about 45% now. And all that has impacted on our performance. In the retail business too, we are steadily growing. The retail deposit is on the increase from month to month and quarter to quarter. We expect to keep that very high. So in terms of what we see in the operating environment, we think the key thing for us is continue to maintain high service quality and also the level of efficiency and operation. Interestingly, we see the key operating variables such as running costs coming down steadily. Quarter on quarter, we've seen a drop from about 40% to about 30%. And we intend to keep that going into the future.
Interesting. So you just touched on some of the key drivers on the earnings so far. But I'd still like you to tell me more around the story here in your cost of funds.
Cost of funds, if you look at it, basically there is drop in yield. All we had to do was quickly reprice our deposit and make sure that we let go the expensive deposit, which is why you notice a slight decrease in our total deposit. We've also continued to be very innovative in terms of how we apply the deposit. So essentially, the key thing for us is that we must earn a reasonable premium in terms of the deposit we take. We don't want to carry deposit just simply because we want to have deposit. The deposit must work for us in terms of adding to the bottom line. And remember, Zenith remains a net placer of funds in the market. And what is also helping us in terms of our cost of fund is the steady growth in our retail deposits.
Okay, so then I'd like you to speak on your loan book, and also the non-performing loans as well as your exposure to Mobile.
Well, for the loan book, if you look at it, there's a bit of growth. That's because there are no growth, like I mentioned earlier. You don't have new investment that we need to support. And we don't go out giving out loans simply because we have the deposit. Because if you look at our liquidity ratio, our liquidity ratio is at 60%, loan-to-deposit ratio at 70%, and our capital adequacy at 25%. So certainly we have ample room for us to do a lot more loan, but it depends on what is available in the market. We will continue to choose and pick the kind of loans we book. But if we find a good loan, we are right and ready to deploy our liquidity accordingly.
All right, then I'd like you to speak on your asset quality, basically, especially with the current economic environment. We're seeing inflation at 11.28% already.
Well, in terms of the inflation rate you mentioned, if you compare year on year to where we are now, you observe that there is a remarkable improvement. And what you also see is that inflation is also, the rate of inflation is also a determinant in terms of the pricing of deposits. So all of them will continue to go hand in hand. So as far as we are concerned, the key thing for us is to ensure that whatever deposit we take, we are able to deploy it. If we are not deploying it in loan, we can deploy it by investment in other available money market instruments apart from placement in the market.
Okay, then I'd like you to speak to your electronic banking segment and what you're seeing playing out in the retail as well. We noticed that you've had quite a lot of investments, in IT, and also some product launches came in a few quarters ago.
I think the good thing to realize here is that Zenith has very strong capability to drive retail business. And this capability you see in our IT resources, so which is what we are deploying now. And we are coming up with quite a number of bespoke products and services, premium products, I would say, and we are penetrating the right segment in the retail business.
Okay, so let's look at how your subsidiaries are performing across board. We've seen Ghana, we've seen the operating environment in Ghana. Right now, there was a lot of shake-up in that sector just a few months ago. Can you speak to how Zenith Bank is performing in the regions outside of Nigeria?
In the geographies outside Nigeria where we're operating, I would say that the subsidiaries are doing pretty well. Ghana is, in particular, is doing exceedingly very well. The market share is on the increase. And in terms of rating now, Ghana is like, our Ghana subsidiary ranks among the top most profitable bank. And in Ghana, we're also the first bank to meet the new minimum capital requirements imposed by the Bank of Ghana. So in terms of ranking, I think our Ghana subsidiary stands shoulder high in the competition. Then the other markets are relatively small. Then relative to the size of the market, I would say that performance is above average. We will continue to support them and to ensure that they grow within the right segment in the market.
Then moving on to your profits, so this year we're seeing this quarter that double-digit growth already in that segment. I'd like you to speak to what played out there.
Essentially, is efficiency. We've decided to be a lot more efficient. We started the program quite a long time, like 2-3 years ago, and what we see is we're going to see a steady improvement. So we are looking critically in terms of the way we do business. We are innovating our product and processes and procedures. We are streamlining and cutting out slags here and there, making sure that we deploy a lot more of electronic solutions to our processes and procedures.
Okay, so then what's your projection for the rest of the year? We're seeing strong numbers here coming in Q3. Are we going to expect better than last year?
If you look at the run rate, if you decide to annualize it, certainly the numbers will be better than what you saw last year. But we'll continue to hold on to the rate of efficiency with which we are doing things. And we'll also be looking at in the market to see what new opportunities we can close out between now and end of the year to ramp up the numbers in terms of fee-based activities. So by and large, I think we should close better than what we did last year.
Finally, we're going into elections next year. We've seen already heated environment in the polity around the elections and campaigns around coming up on board. How do you think this will impact the sector generally?
I don't think the election will impact the sector. What we even see that is impacting is even the numerous moving parts in the global economy. You have talks of Brexit. You have talks of the resumption of Iranian sanctions, the strengthening of the dollar, the upward review of rate by Fed rate, then quite a lot of issues that are there trending in the global economy that have very global impact. I see that impacting more in terms of our business. The penultimate year to election, what we are seeing is not anything different from what we've seen in the past election. You observe foreign investors who want to do a wait and see, so which is why you see some of them exiting. It's not abnormal. I don't see the election posing any problem for the economy.